tax basis of accounting. You prepare your financial statements according to tax law. So whatever the tax code says to treat or how to treat something is how you're going to report it. For example, if you're going to depreciate a building under GAAP, you might say, hey, that has a 30-year useful life. Based on what I said before, you want to pay the minimum amount of tax possible. The tax code might let you depreciate that over 27.5 years or 25 years. Or there's some sort of accelerated mechanism. You're going to take advantage of that because you are going to lower your tax burden currently, right? But it's different than what you would report for GAAP. Again, this is not GAAP. In the accounting realm, a lot of companies will prepare tax basis financial statements only because they care about preparing financial statements to prepare the tax return at the end of the year and not for any other reason. But it's not GAAP. It's not GAAP. There is a basis of accounting that is not accrual, which is accepted by GAAP under specific circumstances, which is called liquidation basis of accounting. Okay? And under the liquidation basis of accounting, what you do is you write down assets to their realizable value. But the only time you do that is when a company is essentially in a process of winding down, of dissolution.
You write down assets? Can you repeat that?
You write down assets to their market value. Okay? And you would only do that, the only way that that would be GAAP is in a company that is in a process of liquidation. Okay? Or in specific subunits. So you've got a division you're shutting down. You're going ahead and write down the value of the assets at that point. Tyler, you had a question?
I was just curious about what, I know maybe you said we'll answer it later, but what the actual answer of your question to Frederick was.
Which I forgot what the question was.
You know, you want to amend my answer? You said I wanted to.
That specific, so that specific answer is, no, it is not a sale because there is not adequacy of down payment. Essentially, the buyer is not at risk.
So if you did put a down payment, then you recognize it.
There is a table, if you read, when you read your book, I
just went through that a little quick. But.
No, it wasn't in this chapter. When you read the book, in 2 or 3 chapters, there is a table that tells you for what type of asset, what percentage down payment is deemed to be, okay?
But that one is what?
There's a more complicated answer.
So if a tree fell in the forest and nobody heard it, did it make any noise?
Oh, absolutely. All the time.
So going back to what I learned on
Accrual.
Okay, so I'm buying.
Guys, we have a question.
You make a contract for a sale, okay?
Of real estate?
Real estate.
Okay.
Based on performance. Okay.
Based on performance?
Yeah, if you sell it, I'll pay you. I mean, I'll give you 6%.
No, so you're not. You've entered into a brokerage contract.
Okay. Yeah.
To be specific, you've entered into a commission arrangement with a seller, contingent upon performance.
Correct.
Okay, keep going.
So I should, under the accrual, how to report it.
Are you the owner of the land who's engaged an agent, or are you the agent?
I'm both, on both sides. I want to know, because if I'm the owner, I don't have any expense now. I haven't spent the money because
If you are the owner, why don't we save that question to the case study, because I think it happens in the case study.
There it is.
We'll go over the case study in a second.
Okay.
Okay? GAAP. We talked about GAAP before. GAAP is not like, there's no book. There's not a book that you could go to the store that says GAAP.
There's no Gap store?
There is a GAAP store. There is a GAAP store. There is no book that says GAAP. Now, there is guidance that tells us how to get to GAAP. There's a long history and story on that. It starts with,
The Italians.
in this country, we're talking about US GAAP. It starts with the accounting research bulletins that predate me, Antoine. Okay, this was before my time. It's from the 50s, okay? So the ARBs were a series of accounting research bulletins that attempted to, ARB 51 attempted to sort of accumulate all the sort of common practices that people used up until that time that were generally accepted, okay? So, again, we talk in sort of ambiguous terms, but, and then, you know, after that, so the ARB had a few pronouncements, then the Accounting Principles Board of the AICPA came out and had a bunch of pronouncements. I think they had 30-something. That lasted till about 19... Okay. Well, I don't know if we need a break. I can take a break too. It's just, you know, I know you guys need a break. It's just, you know, like, you know.
We're rolling, let's do it. Yeah.
Let's get it done. So this goes to about like the 1970s, early 1970s. Then that got disbanded, and they said, hey, we need an independent body, and it created this thing called the Financial Accounting Standards Board. That still exists today. That still promulgates literature, okay? That started issuing, I don't know, I was in college, and I remember FASB 13, which is leases, which we're going to cover next week, coming out. So now they're up to like, I don't know, 170 something, okay? And these are pronouncements. You can buy these things or you can get them on the internet. And they deal with different issues related to revenue recognition, accounting for costs, dealing with leases, dealing with income taxes, you know, whatever, okay? So, I still live in this realm. I still live in this world. In this class, you will hear me refer to the underlying accounting pronouncements. Why? Well, one, that's what I learned. But more importantly, they talk about the specific issue at hand. And in real estate in particular, there are only 4 or 5 underlying pronouncements that we need to deal with. Now, what's happened over time? After pronouncements come out, things happen. Business practices change. Things were ambiguous in the pronouncements. So there's been a series of organizations that have come out over time which have provided guidance. You know, this FIN 46 I talked about. So financial interpretations of the Financial Accounting Standards Board. There are issues that have not been dealt with by FASB. For instance, in the construction industry, the AICPA came up with a statement of position dealing with certain construction company issues. So in addition to these pronouncements, there are a series of independent interpretations or collateral information that feed into what is GAAP. Starting about 4 or 5 years ago, the Financial Accounting Standards Board came up with a process which they called codification. And so everything now is referred to as ASC. And that's the sort of nomenclature you're going to see in that book. ASC, Accounting Codification, okay? Why codify? You've got an original pronouncement, and then you've got all this sort of ancillary, you know, input. So they've kind of turned everything upside down, and they've kind of created this whole codification process, which, you know, starts at 100 or whatever and goes down to 900 and whatever. So, and what it tries to do is it takes 970's real estate, right? So it tries to sort of general real estate. So it takes all of the information, right? But see, under revenues, the reason I think it gets complicated, and we talk that way, so if you go to ASC 360-20, 360 is revenue recognition. So 360-20 is revenue recognition in real estate. Don't write this down, Frederick. Don't, because I'm going to confuse you. Yeah. So what's happened is over and above the 4 or 5 pronouncements that you really need to know on the level of information, they kind of just created this other superstructure to quote. You're going to see those numbers in your book, in your reading, okay? Because that's what, since 2009, 2010, the industry's kind of gone to that sort of reference. In this class, I will let you know what that code is, and I'll tell you what the underlying pronouncement related to it is. Why? Because at the end of the day, there are 4 or 5 issues that we need to deal with in this class, okay? We need to deal with leases. That's FASB 13, okay? We need to deal with sales in real estate. That's 66. We need to deal with development costs. That's 34 and 67. And in particular, 34 deals with interest, construction period interest. We're going to go into detail in each one of the classes, but I'm letting you know what we are going to deal with. Class 2, Class 3, Class 4. We're going to deal with some other things in Class 5. Before I lose my train of thought, please, please. Okay? In Class 5, we're going to deal with a lot of different things. I'm going to deal with taxation, but I'm going to deal with reporting for investments in real estate entities, okay? And that's that could be a whole course into itself, okay? But there, we're dealing with ARB 51, we're dealing with APB 16, let me see, 16 and 29? 18. 18 and FIN 46. Okay? Yeah, I'm going to repeat them now. Class 2, we're going to deal with leases, FASB 13. Week 3, we're going to deal with sales, FASB 66. Week 4, we're going to deal with development costs, which is primarily FASB 67, but as it relates to construction period interest, and because almost all real estate development has a huge component of that, construction period interest is important, we'll deal with FASB 34 as well. And then we'll deal with investment in real estate entities in week number 5. And that goes back to ARB 51 and APB 18. Okay? And FIN 46. In addition to that, in week 5, we are going to deal with fair value. Okay? And that's FASB 144 and 157. Yes, Robert?
In the book, it did make reference a few times to these
ASCs?
These ASCs.
Yeah, so
if we needed to...
I want to tell you.
Okay, good.
360. So this is the ASC. 840. 910. 820. I'll repeat the numbers. I should do them in a different color. Okay, so
976.
I'll give you, okay, so
We'll talk about it.
primarily, we're not going to deal exclusively with these matters, but as it relates to the text and it relates to the accounting related to real estate transactions, issues dealing with leases, both on the lessor and the lessee side, we will deal with in week 2. That is covered or addressed in FASB 13 and covered in ASC 840. Week 3, we're going to deal with revenue recognition, accounting for sales of real estate. That is dealt with in FASB 66 and ASC 360-20, and in general 976, which is real estate. Week 4, we're going to deal with accounting for development costs. That is covered in FASB 67 or FASB 34 as it deals with construction period interest. That is ASC 360. Week 5, we're going to deal with investments in accounting. I'm sorry, investments in real estate entities. Those are addressed in ARB 51, APB 18, and FIN 46, or in ASC 910. And we're also going to deal with the fair value, as it relates to those investments, which are covered in 144 and 157. Okay, FASB 144 and 157, or ASC Section 820.
Now, can we get that stuff online? Do we have to pay for it, or
Can you get what online?
the ASC? Is this?
Well,
is-
they'll tell you what you need to know. Can you, I don't know if you can, I can. And I don't know if I can because I'm a member of the Institute or not. I can go online and access the ASC, the codification. They'd be more than happy to sell you a book. You don't need the book. You don't need to know more than what's in that book. And more importantly, you don't need to know more than what we cover in the class after you read the book.
Okay.
Okay? How's that? Do we have any questions on this?
Yeah.
Yes.
That's on top of the syllabus,
No, it's not on top of. I just I regurgitated the syllabus in different words. So what the syllabus says is that. So the syllabus has like more breakout, more specific items. Because, as I said, if I just make the class 7 hours of leases, we're going to shoot ourselves. So we'll deal with leases for an hour and a half. We'll deal with sales of real estate for an hour and a half. But then we got 5 more hours of material. That's why you see a lot more in the syllabus. Okay, so this is what relates to the accounting component of the class. Now, you don't need to know these numbers. I may mention FASB 5. FASB 5 is accounting for contingencies. I may mention FASB 109. It deals with accounting for income taxes. I probably won't deal, with that very much. I may mention APB 29. APB 29 is like Section 1031, but APB 29 is GAAP. Section 1031 is tax. So it's dealing with non-monetary transactions / not like-kind exchanges. Okay?
Slash not like, say it again?
So like-kind exchange are also called non-monetary exchanges. That's the accounting verbiage.
You what ASC means?
Yeah, it's on the glossary list.
Yeah, it's called accounting codification. What is it? Accounting standards codification. Accounting standards codification. Justin's saying, like, I got this, man. I got this. He's got senioritis. Why do we need financial statements? Who uses them? In this business, why do we need financial statements? If there's only one reason why we would need financial statements in this industry, why would we need them?
Transparency, investment.
Transparency as it relates to who? Who's in it? Ultimately, lenders in general, not just bank. People are going to come to you and say, "How are you doing? Is my loan safe?" Okay. So at the end of the day, we prepare financial statements, and we don't want to prepare it for the tax man. We don't want to prepare it for ourselves. We want to prepare it for somebody else. Okay. And ultimately, in this industry, it's the guy. What's the golden rule, right? What's the golden rule? He who has the gold rules. So the guy who's got the money is going to say, "Let me see your financial statements." Let me say this once, and I'm not going to say it again. Don't bullshit people. If you got bad news in this industry, what is it? Tell people good news, tell people bad news faster. Okay? The minute you get into a situation where you are covering holes, creating fake revenue items, accelerating revenue, holding back expenses, it becomes a spiral you never get out of. MCI, were you born by it? MCI, Enron, all these big blogs ultimately had to do with and we can talk about the agency. There's a whole agency conflict that exists, especially in publicly traded companies with management, right? The difference between what are the incentives and motivations of management versus what are the incentives and motivations of shareholders, right? And they're not exactly the same. And so we refer to that as this agency conflict that exists, and at times management is forced, for whatever the reason, maybe personal in nature, to distort financial statements. Don't get into that. That's all I can tell you. Don't get into that. It is a spiral you will never get out of. So I won't say anything else.
Yeah, Saunders, and Saunders.
If you've got bad news, tell it. And I'll say this: it goes beyond just financial statements. It goes into just general representations that you make with banks. You know, outside the business, you got a working capital line with a borrowing base. You don't need to fudge what your inventory is. You don't need to fudge what your receivables are. You need to, flush through or churn your receivables to make them look like they're current. If you got bad news, go to the bank. What story did I tell? If you owe the bank 20 grand and you can't pay, you got a problem. But if you owe the bank 20 million bucks and you can't pay, who's got the problem? The bank does. So make them your partner. They don't want to be your partner, but they are your partner. Okay? Being a lender is a bad business because there's no upside. Your IRR is fixed. Now, there used to be participating loans in real estate, which you might cover in your finance class. I don't know, but once upon a time, lenders had stake. We saw quite a bit of that in the 1980s in this country with the S&Ls. It also prompted the S&L crisis we had in the late 80s. But your bank is your partner. Whether they have upside or not, make them. I don't know why I'm looking at you with this. I keep looking over there like I don't know why. But be forthcoming. Be forthcoming with who you are.
Do I look like the person that's not?
No. Internal controls. I'll talk a little bit more about this in the last class, but what are internal controls? Internal controls.
Self-audits.
Well, it's not a self-audit, but internal controls are processes, policies that we have in place within a company that allow us ultimately to safeguard our assets. Okay, so they may be for efficiency, they may be for protocol, but ultimately it's a safeguard asset. So ultimately every company has a system of internal controls. And that system of internal control belongs to the company, belongs to management in the company. Okay, auditors come in and review internal controls, but they don't. Okay, post Sarbanes-Oxley, so post Enron, auditors of publicly traded companies do have to issue a report on internal controls, but not of private companies. Okay, so publicly traded companies must pay their auditors to audit and report on their system of internal controls. That is not a requirement for privately traded, for non-publicly traded companies. But most companies have internal controls. Most auditors will come in and evaluate internal controls as part of an audit. They will not opine on the sufficiency or on the efficiency of those internal controls. Okay, but those are structures that belong to management. So a lot of times, why do I bring this up? A lot of times we'll say, oh, there was a fraud and the auditors didn't pick it up. Fraud cannot be detected by normal audit techniques. Fraud can be detected at times by certain forensic techniques that are used when you suspect that there is fraud. But in a normal ongoing financial audit that companies go through, fraud is not detected. Single biggest reason is when there is collusion. Collusion is more than one individual involved in circumventing a system of internal control. Audit tests don't detect them. So audit tests are not designed to detect collusion, for example. And so if two people get together and obviate or bypass a system of internal control, you can't detect it. Okay? So there's a sort of gap between what people think that auditors do. Auditors review internal controls and issue an opinion on the fairness of the financial statements. They don't guarantee or opine or state or in any way imply that there was or there wasn't fraud. Okay, ultimately, fraud should hopefully be detected or avoided by a company's own internal system of controls. And listen, while I go on that, I'll say this. You mentioned I was a commissioner of the Key Rats before I got into coaching high school. I coached, Pee Wee football for a while. And because of that, I got stuck at one point being on the board of the Greater Miami Extreme Youth Football League. That league, in the last 15 years, at times when I was not on the board, during 15 years I've had 3 different officers steal. The first time it was like 30 grand, the last 2 guys stole 60 grand. It's always from the kids, you always read it in the paper. But it's, and the simple control that could have been put in place that would have avoided it required dual signatures on checks.
Sure.
That simple. Now, if there's collusion, if 2 guys decide to steal, and that's how one of the cases was, the president and the treasurer were both stealing. So, and the reason we caught the president was, we caught the treasurer, and so the president forced them out in one meeting. And then, the guy came back and wrote us all an email saying, hey, the only reason I was stealing is because Mike was stealing, and he said that he'd give me the same amount that he was taking. So, but it's simple internal controls, such as, dual signatures, or financial statements, mail being opened up by someone different, from whoever.
The things, the internal control you can do not only with the who signed the check.
Oh, yeah, no.
Who
That,
approve.
yeah, but that was
Okay.
just one. I was just saying that was one
Yeah.
simple internal control. Another one, in that particular case, it was a cash card given out to, an individual, an ATM card. So, the guy was taking out religiously $300 a week, so, anyway, yes, Mike.
What is the emergency issues task something? What is it?
Emergency?
It was on the glossary that you gave us. It was emergency.
Or is this a computer that wasn't supposed to be on?
Oh,
No electronics. What was it? What does it say?
What does it say on that computer?
I mean, just ask me what it is.
emerging issues task.
And the Emerging Issues Task Force, that's another one of these bodies, ancillary bodies, that was providing input. I didn't mention all of them, okay? Okay, taxation matters. I'll leave tax for the last session. The only thing I want to say is, GAAP is one thing, financial reporting is one thing. That's what we're going to talk about the bulk of this class. Tax is something else. That's a whole other world. That's a whole master's program unto itself. Okay? And just suffice to say, I'll spend some time on that in the last class, that GAAP has nothing to do with tax. Tax has to do with public policy, redistribution of wealth, blah, 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 blah. It has nothing to do with financial reporting. It is a set of rules and requirements that are imposed on people for a specific purpose, which has nothing to do with what we're doing in business. It impacts business, takes money from business, takes money from people, but the rules and the policies and the protocol that's used there has nothing to do with logic. It has to do with public policy and politics and a whole bunch of other things. I'm not going to spend any time, substantive time today, talking about managerial accounting. But it does impact real estate, okay? Managerial accounting is a whole discipline within accounting which deals with job costing, okay? And we will, by default, have to deal and understand with job costs in this class. Because real estate, especially development of real estate, is very much a job cost business. So we can be process oriented, right? We can make widgets. What's a widget? Who saw that movie? It was before you were born. Back to School with Rodney Dangerfield. It was a theoretical unit of production. Like, yeah, what the fuck? Okay, so you can be manufacturing widgets, and so you've got departments, right? This department cuts the wood. This department, drills the wood. This department varnishes. This department screws it onto something else. And so in process-oriented environments, what we tend to see is traditional accounting techniques, right? So we measure by division, or by department, or by plant, okay? So it's a process, right? So we say, hey, you know, this department's costing us this, you know. In a job cost environment, we are manufacturing specific, custom manufactured, custom specific items. A house, an office building, a warehouse, right? And we can very closely tie the specific costs of that asset, right, to ultimately match it to a revenue. And so managerial accounting deals with how do you compare the revenues to the expenses of specifically or uniquely manufactured costs. So by default, a lot of what we analyze, especially when we get into development and in the construction arena, is by its nature managerial accounting. You know, we don't get into the same level of variance analysis and break-even analysis that may be done in manufacturing environments, okay? But if you're in the real estate industry, for instance, if you manufacture construction material, you may very well get into, you know, you're making steel bars, or you're making, you know, cement posts, or you're making, you know, drywall. You could be very much in a cost or managerial cost environment, right, where you do need to take a look at things like variable pricing, break-even points, variance analysis, and all of the other items that are addressed in the discipline of managerial accounting. I will not talk about that in this class in that context. I will also not talk about budgets or prospective financial statements. Accounting deals with history. It deals with reality. It's with what happened. It's tangible. It's measurable. It's demonstrable. Everything else is baloney. So all your other classes that you have in this program, that's what you deal with, prospective financial information. Because paper can hold everything, right? I'm being facetious, okay? But accounting deals with the past. Accounting. Perspective, the future, which deals with budgets, forecasts, etc. Okay? You know, that's your investments class, that's your finance class, your market analysis class, etc. Within the context of accounting, we do address these. I won't talk about them in this class, but auditors and accountants can actually issue opinions. They shouldn't say that. They do not issue opinions, but they can issue reports on prospective financial information. So you can apply techniques to make sure that at least there's been, you know, systematic process, right, to accumulate information to look into the future. But we look in the past in accounting. Finance deals more with the future. Now, what I like and why I like to cross the bridge between the two is it's kind of hard to predict the future if you don't know what's happened in the past. And so without a good accounting base, right, it's very difficult to project into the future. You know, and without knowing what history was, you know, the single biggest, when I got into the real estate industry, I always asked the question, why our construction company only did office and industrial? I shouldn't have asked the question. I got the job because we had done a multifamily building and we lost like $4 or $5 million on it, and they got rid of the CFO. He retired. He retired early, okay? But I was, we've got a construction company and we should be able to do anything. And they kept telling me, no, it's just, you know, look, you know, we got our you know, our databases are in this area, our sub-base is in this area, our expertise and knowledge is in this area. And I quickly came to learn, so, you know, we could go talk to somebody and I could tell you, our construction guys, our development guys could tell you within 50 cents a square foot what an office building was going to cost or what a warehouse was going to cost. Well, we couldn't tell you that in a multifamily, but, you know, we'd have to call a bunch of people, rely on subs we hadn't used before, you know. So familiarity is very important. And why could we tell you within 50 cents what it was going to cost to do something there? Because we had a huge database. We had a huge history of, you know, 100 and some odd warehouses that we had built, you know, I don't know, 50, 60 office buildings that we had built, that we had, you know, very precise information that told us what things had cost, right? And you could also compare with subs, prices coming in from subs are out of line, you could push them, so, ultimately, history, right? It may not be fully indicative of what's gonna happen in the future, but it's the best damn thing that we've got. So, budgets and forecasts prepared without any, concern for what's happened in the past or history usually are, doomed to go wrong somewhere along the way. We'll spend in the last thing I want to talk about, sort of accounting, and we'll deal with it with, fair value to some extent, is in accounting, the use of estimates is critical, it's huge. Okay, and you say, well, where? So, for example, valuation reserves against inventory. You say, well, we don't have inventory in real estate. Well, of course you do. If you're a home builder and you're plopping down little homes, those homes are your inventory. You typically think of inventory as like candy or, cookies or whatever at a store. But in real estate, you could have inventory, so, but it could be warranty reserves. You'll find all these things out in the case study that we're coming upon this week. So, you promise you're going to deliver a house, all of a sudden, you bought drywall from China. Now you got to replace it, right? So how much do you estimate for warranties, right? So, depreciation, those are estimates. What is the useful life? What's the right mechanism or manner in which an asset is being devalued? Okay? Percentage of completion. How much have I completed? How much revenue should I recognize? Okay? So, the use of estimates is critical, and we'll address that with fair value, but we'll address it with development costs as part of our discussion there as well. Okay, so that kind of puts us... You guys want to take a... Hold on. I'll give you a 5-minute break. In 1 second, I want to give you a 5-minute break. Okay? All right.
There it is. Oh.
Okay. Relax. Issues involved with real estate. Okay, this is, multiple issues, concerns, things to keep in mind, and why accounting is important, or why all these different issues in accounting are important. Big projects, need for financing and external capital, right? Negotiations, the complexity of the contracts that we enter into with lenders or with other partners. Real estate lends itself incredibly to partnerships that are done. How do you account for those? How do you account for these investments, right? Hey, I'm contributing land, you're putting cash. I think we had that. We'll talk about that in a very simplistic way, right? But, so you've got all these very complex, you've got assets that are long-term in nature. They are highly illiquid. They are subject to risks. Why? Because of the long-term nature. Time, in and of itself, brings uncertainty, right? $1 today is worth more than $1 tomorrow or in a year. Why? Well, there's no risk in it. But money talks and cash screams. If I got it, I can spend it. The promise of $1 in a year, I mean, the world could end. I may not have it, right? So, in and of itself, time brings uncertainty. And real estate has huge development and huge construction periods in which maybe the world doesn't end, but economic cycles change. What happened to the guys that were developing apartment buildings in 2007?
Yeah.
What happened to the people that were building? What if you were a multifamily developer in Dubai in 2007? So, by the way, all those buildings have now been finished, as in most other places. But you've got these long cycles, right? Characteristics, they're assets that are unique. Stuff that's built to suit for a particular, user may not work for somebody else, right? So, you're subject to economic changes. You're subject to demographic changes, right? You're subject to public policy. And you say, well, yeah, how could that really affect real estate? Well, part of the S&L crisis in the late 80s was really predicated by the Tax Reform Act of 1986. So what happened? So, I know you weren't born, Okay, but so that you learn what your grandparents lived through, okay? So we lived through a horrible stagflation period in the late 70s during the Carter, latter years of the Carter administration. We had prime interest rate was at 20.5%. We had inflation at 20%. Unemployment was high. It was horrible. Reagan gets voted into office. There's all these incentive programs. One of the things that are done, so part of supply side economics, a lot of tax credits, a lot of tax incentives, and in particular, investment tax credits that benefited the development industry. So at the time, a lot of the accounting firms, for example, or tax guys would do these, ITC, investment tax credit analysis for developers. So if you're using, I don't want to jump the gun, but if you're developing and you're investing in 1245 property, which is real estate but not 1250 property, okay? So HVAC, escalators, elevators, things like that, you could get an investment tax credit for 15% of the investment. So people are going through, hey, I want to build this building, but at the end of the day, they spent $20 million, they may have been getting $1.5 million, $2 million back in direct tax credits that year. So, fuel's huge, huge development. 1986, in the middle of all this boom, they changed the tax code and said, we're getting rid of that. And nobody's grandfathered. Boom, real estate just died. And with that, all the banks went. But, cities like Houston, cities like Dallas that had huge development going on just died overnight. Because all of a sudden, all these developments didn't make sense and were being done for the investment tax credits that were being generated. So public policy can very much dictate, in a positive or in a negative sense, what happens in this industry. So not only tax laws, property taxes, or changes in property taxes, changes in valuation, changes in zoning, right? Building codes, environmental laws, and all the other things that you're going to deal with in other classes. So you've got these assets that you think you're developing with total clarity, but you don't really know what's happening in the whole world outside. And so, we're going to try to deal with all the different facets or the risks involved with that and how we account for all these matters. Why don't we take a five-minute break? Five-minute break. 5-minute break. Just stretch. We'll get through it. We'll get through it.
Seems so energetic.
Dude, I got to get
waiting for
a lot
us,
of
huh?
work. No, I got a lot of work.
Pick me up.
Sorry?
Said it's a lot of interesting stuff there.
No.
Sí, sí, déjame estudiar. Trae el teléfono y llamamos.
Talking. So what did you decide? Well, first of all,
We need like a coffee machine, una Nespresso machine de esa.
¿Qué cómo? ¿Qué cómo?
Necesitamos como una Nespresso machine.
See, that we should have
something. Okay, at least you're standing up and walking better than.
See, no, el que se sienta, when you're sitting, I know. The other day I went to I took my niece and my brother-in-law to a thing at the Arts Center. So my niece is into all these like artsy things, and so there was a Chinese dance.
Oh, I saw
That's
that.
Shen Yu.
I didn't go, but
That was
Listen.
great, I saw it.
It was, yeah, but here's the problem. It was a little bit too long.
Yeah.
And so what happened was, like, I get up early. I was up at 5:10 this morning. I just no alarm. I was just, but that means at 9 o'clock you're petering out, And so I'm there, and it's like, it was really nice, but I was like dying. I was like, I wish I could just have stood up and and stretched. But it was like the music was really nice. I really liked the music, and I liked the costumes. Were awesome.
But it was too long.
It was too long. It was way too
how
long.
long was the show?
About 3 hours. I don't know.
Not quite.
I don't
but
know. It seemed like forever.
It was like 2.5 hours. It would have been good at 2.
That's a little.
That's
At 2,
one and a half.
and what happened was, some of the routines they did after the intermission were kind of copies of what
Yeah.
it was like, okay, I've seen enough, you know, yeah, I got it.
That can happen in like search shows sometimes where you're waiting till the end of them because they've done a lot of the same stuff over and over again.
Wait, so you're full-time now?
I'm transitioning, so I'm working more and they are writing up the offer. They've given me a range of what it's gonna be written up for. And as soon as I graduate, I'm gonna transition officially into doing.
And you're still happy there, you still like it?
Yeah, I mean, it gets sort of analytical, but I think wherever you start off, you're gonna have to do some of the groundwork.
You have to.
And so I definitely am doing some of it. But he even told me, he said, you know, you really, when you started as an intern, I expected you to just do like all of my little stuff. He's like, but you're doing exactly what I'm doing now. So he'll just say, I don't wanna write this report, you write this report.
Listen, you have to start somewhere. You have to start
Exactly.
somewhere, and it's a great company.
It's a great company, they have great benefits. And I get a lot of opportunities to learn from a lot of people. I mean, if I want to go to a meeting where Coral Springs, like, Harry Styles was speaking at a meeting, and they were like, oh, you go during, like, office hours, we're gonna pay for your gas, we're gonna pay for your entry, like, I can go to, like, ULI conferences once I'm there full time, they'll pay for everything, and I think that it's great for me as a stepping stone, and
I think it's awesome.
if I'll stay there, like, long term, but I think for the next few years, you know, that's exactly where I'll be. But I actually brought you this. We put together a book. There was an event. I don't know if you ever got the invite for it. I tried to add you to the list, but you may have been out of town. But I thought you might like a copy of the book that we put together at it.
I don't recall having seen an invitation to a JLL event, but
Okay.
I love this kind of stuff.
Yeah, I figured you would appreciate it, so I brought
Awesome.
that for you. I'm also, one of my first semesters, I did a project on air rights. I did a report on it, and I've been totally infatuated by them since. I didn't know, because I'm trying to eventually turn it into a white page maybe for JLL, since I write reports and different things anyways. I didn't know if you had resources or where you can get information, because it is so hard to find anything on them.
I know we sold air rights once to a guy for $2 million over our rail line. Terra, and he never developed the building, so we collected the money and.
There's a few who have done it. I mean, over Mary Brickell Village, there was some, Limo District, there was some, but like, and Miami 21 uses it, but there's no.
I would have to tell you, I mean, you would have to find a very specialized land, it's not really a land use attorney, somebody, I would tell you, I mean, do you have contacts at Ackerman would probably, I would tell you, I mean, Greenberg has a big real estate practice, yeah. So, I've always thought that people at Ackerman were more sort of professional. Isn't Neeson Kasdan on our board or something?
Maybe.
He was at one time, he's the senior partner at Ackerman. And he had been the mayor of Miami Beach, I mean, he's a land use attorney but I thought he was on our board. Who does JLL use to represent them?
As far as attorneys,
Yeah.
there's, I don't know, because I haven't dealt with that. I know we have in-house legal too.
Yeah, but you should see, you should see who they use corporately.
Yeah.
And even if you say, oh, well, they use Skadden Arps. Skadden Arps has a real estate group. In fact, their real estate group is based in Chicago. So they may actually do work for JLL.
Yeah.
Because it's a big practice there for them. But you need to find someone who would, that's like someone who has a specialty within a large firm where when a case comes up, they pull that person in.
No, of course. And there's very few people who do it.
But I would start with,
Where we know you were born.
see if you can talk to somebody in
What year were you born?
What year you put,
Okay.
or even if there's local counsel that's used for transactions.
92.
Like, you know, who do they use on it, even just the leasing side. You know,
I have 23 years.
but see if you can find a
27.
friendly
I'll be
real
28.
estate guy from a large firm
Yeah.
Don't worry.
that you
A
can
lot of
call and say,
stuff
hey,
he's
look,
talking about, I don't know
there's
either. I just
somebody
don't
in
say
your firm
anything.
that
Yeah,
has
yeah,
a
go
little
to
doing
you.
whatever on on it, but I
just graduated
I need to tap
from school.
into-
Yeah.
Yeah.
Last
That's
year.
what happened with me.
Yeah.
I took my bachelor. I just
And
finished
you
my
might say,
bachelor.
look,
Ah, you
maybe
just
I can
finished
co-write
work?
something with one of your
Huh?
partners
In
or
Noble?
something.
No,
Yeah,
actually in Iowa.
Ah, Iowa.
Yeah, I went to
What do you
school.
study? Business?
I did business administration with finance and project
And then you start
management.
here
The
directly.
next month I was.
Ah, the next month. So you moved from Idaho to Miami.
I actually did it online.
Ah, you did it online.
I did the whole 4 years online.
Really? It's not tough on you? It's kind of
It's a lot of work,
different, huh?
but it's
But
better
you
'cause
really learn?
I came into school as an adult. You know, I didn't
Yeah.
go in 18.
But you learn, like online, you really
I've
learn?
always been a self-taught person anyway, you know, so it was easier for me. It was a lot of work, but it was easier for me because
Well, like the whole day in your house in the computer doing
Now it's
everything.
development, you know, the denser we
That's
get,
it.
and that's why it becomes
They're selling
important.
density.
but it's a lot of work though.
Essays, probably.
The only thing though, you know, when you go to school, you got to deal with other people. You know, they're socializing
different.
things.
Yeah.
It's stuff that takes your attention away from what you're trying to
I
learn.
wish that I mean, we
But with online,
sold it to Pedro.
it's
You learn
all
quickly.
just what you got to do. I ain't got to worry about what I'm wearing.
Yeah.
I just focus on.
This is what semester? Your second
This is
semester?
my last.
Ah, this is your last.
Yeah. I started in June of
June
last
last year. Oh, you were done.
year. Well, I started in July. I finished my bachelor's
And
in
into an
June,
adjacent lot and
and
over
then
our rail line.
started here.
You're
But
over.
they did that just prior to
What are you gonna do
their
after
buying
work?
us, so I don't even know.
In the industry?
I'm gonna start with a firm. Hopefully,
What firm?
I don't know.
Ah, you're
It's
looking for a
still
firm.
open. I'm gonna start with a firm for hopefully
Here's
the
what I'm
next
gonna
3
do.
years,
Here's what
get
I'm
some
gonna do.
experience,
Next
and
week
then
I have
honestly I'm gonna try to
The
start
thing is that
working
I'm
on
international, so I have student visa and it's kind of
You gotta keep doing
complicated. I have to maintain my status and everything, so it's
Yeah, we had
really
one of
tough.
the young ladies that was here last semester. She had a visa as
You
well.
can start with
So
the
it's like you're like, you do not, some companies ask you to be a resident or U.S.
He doesn't deal with
citizen.
the operating, he's an accounting guy.
But
But he might tell
she
you.
got a job right after too. So
Here, after being here,
it was the process she had to go through, but she got it.
A few articles that were posted recently, and I emailed like the authors of them being like, hey, where'd you get your information? Like, never hear back from them. But yeah, no. So I figured I'd ask you when you mentioned air rights, like for.
No, it just happened, it just happened, it just happened to me, that's why.
I know, but then I was like, oh, I'll ask him maybe because. So let me know what you think.
I will. I mean, just visually, it's very nice, so that's a good start because it pulls you in.
Yeah, the research team put it together and then marketing sort of made it all look like that.
Okay, class, you're visiting. Oh, you
He's
found us.
Yeah.
Where did they tell you to go? Okay, all right, Mona, you're here. Okay, class. Okay, so we're starting. Listen, guys. Antoine, I'm sorry, I've ignored you twice.
I know.
I'm sorry, dude. Listen, stick around after class. I'll give you all the time you need. Okay. I was thinking, I was talking, so one of my sisters is here, and so she's here with her husband and her kids. I took the boy and one of my other nephews to a hockey game the other day. So my mom tells me, like, she goes, oh yeah, your other nephew's taking this one to the hockey game, and they're not inviting me. I'm like, he's got tickets for a box and all this. And I'm like, dude, like, how rude. I was just thinking I could get free beer or something. Okay, class. Okay, so we're going to go over the case study now.
Can I pull out my submission? It's on the computer.
Why don't we go over it conceptually? I'm gonna tell you, listen. So, let me just, so conceptually, case study. Listen, like, everybody, so if you turn in a case study, you got a grade. And you got a good grade. Because I didn't really grade these things, okay? Now, if you turn it in late, you got points taken off. I will not take any more late submissions. Let me repeat that. I will not take any late submissions, and I'm serious.
No
I don't
deferments?
care the dog ate it, I don't care. I will not take late submissions, okay? So it's that simple, it's business protocol. So manage your time, you got 2 weeks to do things, you know, I will not take late submissions. So, just work with that parameter, and then you got everything sorted out.
It's due in 2 weeks? I thought it's the week of every.
Well, right, like, okay, 10 days.
Yeah, we need specifics.
10 days, I mean, you know.
Calendar
It's
days?
10,
Calendar days or business days?
Fiscal days.
Did we move it from 3 to midnight?
all right, okay. No, listen, so if I move it to midnight, listen, it's what happened. So this one, it kind of strolled in or whatever. I know what's going to happen is next week, I'm going to get a bunch of things at 2:58, 2:50. I've been to this movie before. So it's an issue of, it's a repeat, okay? It's an issue of working on it in advance, okay? So if we wait till the last minute, then we rush, and it should not come as a surprise to the person who reviews all these submissions can tell the difference between the ones who took their time and the ones who just hastily slapped something together at the last minute to meet a deadline. Especially in this one coming up, that those will have, like, the last few answers won't be covered. I know that. I've seen this one before. It'll be like, they'll stop on question 13 or whatever. You know, it's like, you know, it's not like they skipped certain things. It's just you could still run out of time. Read the case study. Read what's being asked. These are just suggestions from the submissions that I saw. Read first. Absorb what you're trying to accomplish. Use the right tool to find your solution. 7 of you submitted this case study in Word. What would have been probably a more appropriate tool to use for something with numbers? Excel. Pick the right tool. I can already tell you the one coming up is a Word submission, okay? There might be the use for a small Excel spreadsheet for 1 or 2 of the answers, but it's a Word document. But the tools are free. Find the right tool, right? Send source documents. And embedded, I'm looking at you because I know you had it. I'm looking at you because I know you had it. Several of you embedded spreadsheets as pictures in a Word document. I can't see it. I can't see it. I can't see this now. It's less relevant in the one that we had as it will be in the ones coming up. I can't see the syntax in what is pasted that way. I can show those of you who don't know another day how to paste a spreadsheet into a Word document. Okay, so that's a neat little tool to have to use. You can even embed a spreadsheet, but if you plug in a picture, I can't go in there. And to take an Excel spreadsheet and just convert it to a table, you kind of lose the benefit of having the Excel.
Yeah.
So, cover pages. Most of you send in a cover page. I require cover pages. In fact, I don't require it. The university requires it. If the other teachers require it or not is irrelevant to me. I want them signed. Take one, sign it, scan it, embed it on your spreadsheet. Okay? Don't type your name, don't leave it blank, sign it. It's a statement of authorship. It is a statement that says, I have done this. I don't know, maybe I'm anal. When I did my master's program, I did it. Most students didn't do it. Most teachers didn't require it. But it was my cover page. Yes, Mr. Mancini?
You got your signature okay?
No. I said, take a picture, scan it, take a picture. Take your little thing. And you just embed it. And you know what? You can take a blank one and you can handwrite each assignment. So you don't have to do it once. You can even sign it once and then just take a quick little picture of it, please. Protocol, syntax for the file. Give me your last name.
Saunders.
Is there some noisy in here? Okay, dot whatever, DLCX or whatever. Okay, if you don't put your name, I got 20 students now. If you don't put your name on your file, I don't know who it came from. Or what do I have to do? What I did last time with like 7 or 8 of them. I have to then save them with a different name and put your name on it. You know, just nice and simple. Put your name on the file. Dot, whatever the file. I don't care what that says. Please, put your names on the files. Please put your names on your files. Since you write, I'm going to repeat it. I will not take any more late assignments. Okay?
The worst part.
Full stop.
It was done.
Full stop. They say that in England. My sisters are around, so. But source documents. I can't review PDFs. It's hard for me to review PDFs. Now, it's easier with Word documents, but with Excel, especially, I can't look at links. I can't look at formulas. I can't look at methodology. I need source documents. I already said this before. Where do you leave your spreadsheets? I mean, you can do whatever you want. I'm telling you it's going to impact your grade because ultimately, it's like a response to an RFP. If you give your instructor something that's easy to read, Alyssa just gave me this. This was something that was put together at JLL where she works, right? And so I haven't had a chance to look at it. It's got all kinds of statistics and information. And she says, I hope you like it. And I said, just visually, it already pulls the reader in, right? So if you give your instructor or if you give your client or the recipient of an RFP clutter, they're not going to be able to process it, right? You don't send them a book on the last page, right? You send them a book with the first page first, right? So leave your spreadsheets. Get into the habit of leaving your spreadsheets where you want people to flow from. Answer things. Again, this one was easy. This one was answer 1, 2, 3, 4, 5, 6. Some of the other case studies might be, and maybe in other classes you might need to do, projections or whatever, right? You might need to have assumptions. Group your assumptions in one place, right? And from there, maybe you can flow to, a projection. And obviously, you start with an, earlier period and then with a later period, right? You might have an analysis section underneath. But try to group thoughts and ideas in a way and in a fashion that makes it easy for the reader to follow and to understand. There's some guys I know, they're like kids that people gave them money and they're buying multifamily everywhere and they want me to invest with them. And they sent me a spreadsheet the other day and I was actually impressed. I don't trust them, I'm not going to give them any money. But the spreadsheet, was easy to follow. It was very complex, but you could follow it. I could see their assumptions, right? I could see the results. I could do quick analysis. I could make a decision. I like the asset. I don't like the management, but I like the asset. I like their story made sense. If they sent me something that was like all over the place, I wouldn't even look at it. And that's the same thing, listen, at the end of the day, you're going to be putting books together. You guys, you want to make billions, you got to convince people to give you money to start, right? Or to buy from you, whatever you sell, right? Or a lender to give you money. So, get into the habits of creating books that people can follow, that people can read. Spreadsheets that people can understand. Spreadsheets that flow. I know that in your investments class, it may not work as easy because some of the analysis, to do some of the financial analysis, definitely to do sensitivity analysis and to build tables, you need to have all the information on one tab. But, in accounting, I always like to build, right, from the back up, right? So, as an example, using a balance sheet, right? I might, on the first tab, have a balance sheet, right? Right? And if I want analysis on any of the accounts, let's say cash and accounts receivable and PP&E, just to say something, plant, property, and equipment. I may have tabs here that, in cash, maybe I have my bank reconciliation here. And maybe for accounts receivable, I'll have an aging here, right? And here I may have a fixed asset rollover, okay? And so all this information flows from the back up, right? In some sort of sequential or logical fashion that a reader can look at. When we sold Florida East Coast Industries to Fortress, the final projection that we put out was version 69, okay, of a spreadsheet that had like 300 tabs in it. So imagine if you were trying to review that in a short period of time and get your hands around that, if it wasn't organized in some fashion that people could look at. And that people could easily, you have to make it easy for them to then also modify their assumptions. Why do we use Argus? Why is Argus a de facto tool in the real estate development business? Because everybody uses it. So if I'm trying to sell a building, I'm going to give you my Argus run. Why? Because you can very quickly modify the assumptions and create your own model. Right? So you want to facilitate, if you want to sell something, you got to make it easy for people to buy. So, you know, the proxy is if you want a good grade, right, you got to, like, you know, pull your instructor in. But this is, it's a learning process. It's not because of the grade, it's because of the methodology, right? You know, so try to build, you know, detail up to summary. Detail up to summary. Use the right tool, okay? Don't hard code numbers. I'm warning you for other ones. That wasn't the case here. Remember, use tabs. Tabs are free, you know, headings, right? You know, use pleasing colors. I mean, I always get, one day I could come here and I'll put on the screen, I can show you some of the spreadsheets I use. And it's techniques I've learned from other people, okay? So the good thing with a program like this and with multiple instructors is that you will see people that have been in the industry that will show you different ways of doing things, right? Learn from them, which is not to in any way inhibit your creativity, but it's to give you ideas of what people that have worked with lenders and with partners put together and say, hey, maybe people are accustomed to, you know, seeing this format or seeing these things. But you know, like, why do we use pastels in buildings in South Florida? Because they're pleasing to the eye, you know? So, you know, don't highlight stuff with like fluorescent yellow and red and green and brown, and, you know, it's harsh on the eyes. And it sounds all silly, right? But, you know, use a light yellow, you know, and a light gray or a light blue, you know? You know, make things big so people can see it. I'm just, you know, just sort of, you know, ideas and concepts. So let's go to the case. So when I was asked originally to teach this class, there was no material, and so I thought it'd be important to always use different cases. This one in particular, more than anything, was, one, it helps me gauge what the level of accounting is within the class, and it validates the fact that we need to probably focus less on accounting and more on analysis than on accounting. But each one of these items are very generic concepts that we're going to deal with in one way or another, but ultimately go back to what is a reinforcement of the accrual basis of accounting. Maricela was asking at lunch, you know, well, if you paid for it, let's see, because you've got a whole sorts of different situations here. A service was rendered, but it wasn't billed. Is that revenue, right? A service was rendered, but wasn't paid. Is that an expense? Cash was exchanged, but the service wasn't rendered. Is that revenue? So there were just different simple situations that are trying to reinforce the concept that I explained before. Income is recognized when it's earned. Expenses are recorded when they are incurred. 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 Nothing is recognized on your profit and loss statement when cash is exchanged. Now, it may be that cash is exchanged at the time the service is rendered and revenue is earned, but it's not when cash changes hands that determines when we recognize an item. It's when the service is rendered, okay? When the culmination of the sales process takes place, when title transfers, right? When risk of loss transfers, okay? So, so I was on a cruise with my parents off the coast of Brazil, and I was working every day instead of doing shore excursions, and I did this thing and the balance of the class. So that's why you see things like Bahia and Janeiro Gardens and all that kind of stuff. So anyway, so we can go through these. I'll show you when we're done. I'll show you how I answered the case, okay? Which is not how everybody needs to answer, but I'll just answer. I'll show you how I answered it. But I'd rather go through, because there were 10 simple questions in the back, right? But the facts were addressed in bullet points. And so the first thing, what I did is, I grouped the bullet points by the question. So I said, okay, bullet points 1 and 2 deal with question number 1. So let me come up with question number 1, right? Question number 1 ultimately was prepare a balance sheet at the beginning of the year. 2 simple answers. Let me just pop up my suggested answers, and in that way it's... You want to see my suggested answers?
We want to see the colors you use.
Okay, let me make this a little bit smaller if I can. If I don't turn this on, okay, so there are 2 contributions of assets, land and cash. Okay, the land had a basis of $500, or a market value of $1,000. What does it get recorded at? Are assets recorded on the company at the time of contribution at fair market value or at historical basis?
Whatever is lower.
I hear fair market value.
Whatever is lower. Whatever is lower, most conservative.
Okay, so I'm hearing lower of cost or lower, whatever's more conservative. Any other answers? Okay, so they are contributed and recorded at fair market value. Now, for tax purposes, that particular shareholder has carryover basis. So his basis would carry over, okay? I actually set this up. This is my answer. That doesn't mean you needed to, I set it up as an incorporated. So this is a corporation, this is not a tax efficient entity. So what would happen in a case like this is the corporation, for tax purposes, would carry over the basis, but for book purposes, you need to record the asset at the fair market value at the time of contribution. And ultimately, there were $2,000 worth of equity. Now, so the basic thing is, I got cash and I got land, each for $1,000, and I've got capital or common stock or shareholders' equity or however you want to create it, okay, at $2,000. That's the balance sheet. Notice name of statement, date. Assets equal liabilities plus owner's equity. Now, start looking at some of this stuff because you're going to learn these things. And this is ultimately all these little things, all these symbols, all these lines, all these periods, all these commas, they all mean something. They didn't just get invented for the heck of it, right? So, in accounting jargon and accounting statements, dollar signs indicate the beginning of a column. Underscores indicate what? Where you're going to sum something. Double underscores indicate what?
Total.
Totals. Okay? So, we don't just put dollar signs on everything. Okay, a word of advice in the future for spreadsheets. If you're going to use pennies everywhere. If you're not going to use pennies, don't use pennies anywhere. You probably don't need to use pennies in the case studies we do here. You will in the financial analysis one, but you know, for big projections, don't use pennies. I put pennies here on purpose just to show it, but you know, start learning, okay? Okay, now, that's one way to look at it, but there was an alternative presentation. There were $50 that were paid, right, by the company as of that date for organizational fees. Organizational fees are capitalizable and amortized over a 5-year period, okay? That's common And so the alternative presentation of the balance sheet would have really been that, okay? So we would have, you know, assumed that the $50 were paid for the organizational costs, and they are deferred. What does deferred mean? Deferred or activated or put on a balance sheet or hung up on a balance sheet, which is something that's important in real estate, says we have incurred a cost which is going to have a future benefit, and it's going to have revenue associated with it. Okay? One of the basic underlying premises of accounting, of GAAP, is what we call the matching principle. We are always going to move or record things to try to best match revenues with expenses. Okay? So, the example I've used is, if we build a building and we take all the things to cost, we're going to have a big loss year one, and the year we sell it, year two, we're going to have a huge profit. No cost. That doesn't give the reader a good idea. We'll go into that in week 3 when we go into, week 4 when we go into FASB 67, okay? But anytime we hang up a cost on the balance sheet is because there is a perception that there is a future benefit. There is some income stream in the future that's going to come from it or to be associated with it. Any questions on one? Yes, Alyssa.
Couldn't the organizational costs been in accounts payable because it didn't say that?
Well, if you didn't pay them, you could have put that, you'd leave that at 1,000 and you'd create a liability of $50 there. Okay? That's one way to do that. Now,
Did the individual pay for that?
no, so the individuals paid, so that's the next question, right? So the individuals paid for, you know, their legal costs, okay? That's question number 2, okay? So question number 2 is, well, it's embedded in, it's obviously embedded there. Question number 2 is, here's the journal entry that needed to be made, okay? So here's the general journal, okay? For the year ending, name of the company, date, journal entry number 1. Notice the level of detail, right? Whoever's looking at this knows what this is. Debit $50 worth cost, credit cash to reflect the payment of organizational costs. No, items paid personally are excluded from, and that's another thing that I want to say. That's a big problem with real estate businesses. Real estate developers love to intermingle and run personal items to the company, and you know, and ultimately accounting talks about the record keeping for a particular entity. That entity is like a physical person. So if 2 owners, you know, spent money negotiating for something that was not corporately related, the company shouldn't pay for that. Now, have I seen companies pay for those expenses in the past? Yeah, I have. Yes, I have. Is it the right thing to do? No, it isn't. But I've seen it. And I've seen it too. We did a joint venture. I know you're not going to believe it. It took 4 years to negotiate the documents. And we were working for years with a large institution without a final signed document. So we spent a couple $100,000 on the legal fees, and we paid for it. We finally get the deal done, and our partner sends us a bill for $1 million from their attorney and says, pay it through the venture. Dude, I mean, those are your costs. I mean, why'd you pay $1 million? I mean, you know, he was actually a fat guy. And I mean, he really was. He probably ate it all, but...
Won't you incur, like, if you're organizing a company, you haven't yet organized it yet, so you're going to naturally incur expenses personally that would be just an additional pay of capital.
Okay, so I'm not going to argue with the fact that this particular... No, what I would say is, listen, this is all interpretation at the end of the day, right? So, you know, at the end of the day, it's about being prudent, okay? So, this is a simple made-up case. I can understand how you could say, hey, this part of the organization of the company, you know, I wouldn't have incurred these costs otherwise, right. Okay? The way I wrote it, and I'm not trying to be nitpicky, is they each paid, they personally incurred for their review of the legal documents. There is a distinction. There's a distinction between an entity's organizational documents and the partners' review of those documents. And by the way, this example I gave you became a very contentious issue between two partners, okay? Because one thing is what the entity incurred in the formation or the creation of itself, and the other thing is what the partners decided to, dicker on a shareholders agreement or the partners agreement. And one guy pissed away $1 million and then he wanted to split that with the other guy. So in this case, yeah, would it be wrong, totally wrong, that another $25 would have been in there and included and paid in capital? No. Is it preferred? I would say it's probably not conservative. But is it totally wrong? No.
But those guys wouldn't have bickered unless it was for the creation.
I understand that, but there is still a distinction. And here's what I want you to take from here. What I want you to take from here is what belongs in the company goes to the company, and what belongs to a shareholder stays outside the company.
Okay.
I'm not saying it's right or wrong. So a meal with a client stays in the company. A meal with your family that you can run through the company doesn't belong in the company. That's the message I'm trying to convey here. Okay? Yeah?
I don't like this class anymore.
Okay. Question number 3 was, okay, so question number 3 was, they engaged Ronaldo Santos, right, Ronaldinho, right, from Santos, right, to perform land planning services. So they engaged him on the 20th, but he did not invoice till the 5th. He incurred the expenses, right? Now, let's go over here. So on the 20th of January, now why do I put it to land? Well, we haven't done FASB 67 yet, but FASB 67 is going to tell us that costs incurred in the development process need to be capitalized. So that's why I put it to land. And now I'm jumping ahead, okay? But the issue here is the day that the services were rendered, you need to recognize a liability, okay? And then the day you pay, see, this only affects the balance sheet. You debit payables and you credit cash. So you still have to record the cash exchange, but it should not impact your P&L at that date. Yes, ma'am.
I understand that in the journal entry capitalize the cost, yes, that you pay for the land planning. But I think if I use land planning as an account, at the end, because if not, the reader cannot understand. If you put in the general ledger, is land, and you cannot identify different things related to the land.
Okay, right, but that's why
What do you suggest?
Well, that's why we use job costing in real estate development.
Yeah.
And that's why in class number 3 or number 4, I'm going to show you how there are subledgers that ultimately you wind up with one line item, but you can see how all of the different components are grouped in a subledger. Okay? Irene.
Question. He was engaged on the 15th.
Yes.
Delivered on 20 and invoiced on the 5th.
Yes.
Shouldn't I entry on the 15th?
On the 15th, you engaged them, but he didn't do the work till the 20th. So I enter into a contract with you. It's like the commission one. I enter into a contract with you, but I haven't done the work yet. On the 20th, he delivered the job.
He signed the contract. He signed the contract?
No, he delivered his plan.
Oh.
Yeah.
So I engaged him on the 20th, on the 15th, but he didn't earn, and I didn't incur the expense till he delivered that plan. So it's not an expense until it's been delivered. So you engage a broker to earn a commission upon the deliverance of a particular service when they bring a buyer. the day you sign the contract with her, you may have an obligation, but you don't have a liability. You have an obligation. You have a contingent obligation. So, one of the things you look at in footnotes to financial statements are contingencies and commitments.
And you put in the footnotes and
You don't necessarily,
put as an accrual thing.
if you have not incurred a liability, no. If you have not incurred a liability, no. And we'll go into that, for example, as it relates to how do we disclose operating leases and footnotes where we have a contract, where we have a commitment,
Yeah.
but we don't record the liability. We'll talk with leases on that in particular. Okay? But not everything that is a commitment or a contingency is a liability. Not everything that is a commitment or a contingency is a liability. I have a commitment to buy a house from you when you finish it in 5 years or in 3 months. You're a home builder. I enter into a contract to buy a house from you. I have a commitment with you. But until you deliver the house, I don't owe you anything. So I am committed to you, but I don't have an expense yet.
But you have to keep track of it somehow?
Well, that's why in footnotes, we disclose footnote in the footnotes, commitments and contingencies.
Okay, so there's no, for commitments that don't result in a liability, there is no journal entry at that time. There's no
Right,
recording of it, there's just.
Right, now, I said no, listen, listen. Okay, so hold on, let me not complicate things. I said I was gonna talk about FASB 5, okay? FASB number 5 deals with commitments and contingencies, and basically what it says is if a contingency is probable, so it's known,
Yeah.
if it's known, if it's probable, and the cost could be estimated, then you need to record it. But that's a contingency, and as it relates to real estate, I'm going to give you an example of one. I have a notice from a regulatory body regarding an environmental contamination. So I know I have a contingency. I know it's probable because I hired a company and they did a study and yeah, there's a problem. And they told me it's going to cost me $100,000 to remediate it. Okay, I don't have a final ruling yet from the environmental authority, but I pretty much know I'm going to be on the hook. Okay, I got to record that. But there's a difference between that level of contingency and a commitment that I have to purchase a good or a service. I'll give you an example. 2005, it was almost impossible in Dade County to buy construction film. So it's a cartel. There's 3, well, I guess there's fewer now, but you know, Florida Rock, Rinker's now Cemex, and Vulcan bought Florida Rock. So it's like Vulcan, White Rock, and Cemex. There's 3 guys you can buy, and they're all in cahoots. Okay, so you were on allocation. So you could only buy, you know what allocation is? You buy a proportional share of what they're willing to sell based upon what you've purchased in the past. So we entered into a commitment with White Rock, which was a supplier we used, where they gave us the ability to purchase X tons over a period of time, okay, based upon what we consumed in the past. Now, we had a commitment with them to purchase X amount of tons, but we didn't have an obligation and we didn't have a liability until we took those tons from them. So a contract, we were going to perform on it, but it wasn't a liability until we got the fill. Yeah? No?
So you record it when the day you get it?
The day I received the good or service. Alyssa, you had a question?
You answered my question.
Okay.
I have a
And
question.
you put it on your footnote every,
But if you,
Well, if it's material, yes. You don't, put every...
but if
Yeah.
you are in the middle, if you're not at the end of the year, for example, you use a calendar year in your account. It's in the middle of the year, and you don't use footnotes in the middle, in the trial balance, in the,
Well,
you don't use.
well,
You need the balance sheet, for example, for 6 months to give to the lender, and you don't use the journal entry, and you don't put the footnotes.
Well,
It's not,
well, first of all, okay, so public companies report quarterly in this country.
yeah, well, okay.
And you have to have a full set, okay. If you're reporting to a bank, you're reporting at least monthly. Now, if you have a construction loan from a bank, you're gonna report monthly, they're not gonna care about footnotes. But if you have a working capital line, you know, with a bank, and you're reporting monthly, you better have footnotes with at least significant commitments. And ultimately, as management, so what do most lenders ask you to do? As management, they expect you to sign, you know, represent that those financial statements are, you know, and you get into, that's one of the negotiations that you get with lenders, because they want you to certify that they're true and fair and accurate, and those are big words, right? But if they're true and fair and accurate, and all the other words that the bank want you to certify the statements, then they better be. So if you're asking me, would I sign a set of statements or deliver a set of statements to a bank that didn't have footnotes? I wouldn't. Now, there's maybe plenty of other people that won't, but I wouldn't. And neither should you. Because then somebody come back and say, hey, wait a minute, we didn't know you had this commitment. Oh, well, yeah, well, we didn't do footnotes because we don't do footnotes every month. So how many components are there to a set of financial statements? 5, right? Was it like a cover page, a balance sheet, an income statement, a statement of cash flow, and footnotes? And if I repeat things in class 2 or 3 times, there's a reason why you may need to know that, like at 5:45, okay? So if I repeat things over and over again, there's a reason, okay? Let's move on, okay? So,
You want to repeat that one more time?
no. Okay. So now we hire an exclusive, we hire an agent, you know, so, you know, I exaggerate, right? The broker always like coughs, you know, whatever, I beat up on broker. So now I've entered, as a conclusion, as a summary of the conversation we just had, I've entered into a contract with a broker. I have a commitment with them, okay? I'm gonna have to pay them something when they deliver something, when they deliver a buyer, but they haven't done anything yet. So I don't have to record anything on my financial statements yet, okay? Question number 5. Well, so the next point in the discussion was this. The next point in the discussion was the payment. We paid Santos on the 5th, okay? So now, we get to question number 5. Okay, question number 5 was, okay, so we engage, so listen to this. We engage Bahia. This is a situation. We engage Bahia. We pay him $50, but he hasn't done anything yet. So now we've got a situation where we're out the cash, but we don't have the service. What do we have?
Advance.
With not accounts payable. Well, so we would call that, in accounting, we would call that prepaid expenses. Okay, so it's an advance that we've made. He would have to record a liability called customer deposits. Okay? And there's plenty of people, how do you think Microsoft finances itself? You know, you pay a license fee that's good for a year at the beginning of a year, and it's a free finance. How do you think cruise lines finance themselves? You pay for a cruise, how far in advance? A year in advance, and then they deliver the service, but that's a liability. That's a customer deposit. So we'll have something similar to that here. So prepaid expenses 50, cash 50. Okay, it's an asset. Prepaid expenses happens with insurance. It's a lot of things you prepay. You pay in advance, but the service hasn't been. Now, to get the ultimate solution, okay, to pay the ultimate solution, you need to record the final payment to this guy. Okay, and what I did at this point is because the service was done, okay, and it related to land development, I put it as part of land cost. You didn't need to do that for the answer, but you need to do that in order to get the final answer. Question number 6. Okay, we paid Porto $100. So part of that was a prepayment, right, in advance of a commission, and the other part of it was selling expenses, right? Yeah, but to sell. It was to sell. And And we'll deal, in FASB 66, we'll deal with sales expenses. Okay, so how do you deal with, do you capitalize them, do you expense them, whatever, okay? The short of it is sales expenses are expensed currently because we don't know whether they're going to have any future benefit. There's some exceptions, but we'll go through that in detail, okay? So, cash, credit cash, $100, okay? Prepaid, $25, and selling expenses, $75. We're going to assume that the $75 we're giving them is gone. Okay? So, again, I'm sort of jumping some weeks ahead, okay? But the advance against the commission is a prepayment, okay? Similar to the question before. Question number 7. All right, so we entered into a contract with Recife. He wants to buy our land. He gives us $1,000, okay? This is the opposite of what I just mentioned. So now we're Microsoft, now we're the cruise line. We've received the